G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Be sure to check out my links below, including exchanges I use and social media content that I post. Alright, let's go. So topic for this video, we're just going over retail sales numbers just come out. The US. Also look at Walmart and their earnings report that just come out as well. And the rate cut probabilities, what we're seeing going into next month. And just go over the charts with the stock market to see how well the day went yesterday. And surprisingly, you'll see where it's at. So, yeah, we'll have to get to that at the end. But at the moment, we'll stick with what we've got right now. So, we have retail sales month-over-month numbers for July just come out. And the consensus was 0.3%. And it came in at 1%. Previously, it was minus 0.2%, so it did beat consensus by a lot. And, yeah, that was positive for the stock market, seeing that data come in. So the consumer is still sort of holding up unexpectedly. I didn't think it'll be that strong, but it did come in nevertheless, 1%. So we had previously June, month-over-month, so minus 2.2, 0.2, minus 0.2, 0.5, 0.7, minus 0.1, 0.1. So very bad January. December 0.4, November 0.1, and minus a number in October, 0.8 September, and August 2023. So actually from going back there nearly a year ago, it's done a lot better. Okay. And the last time we got a 1% reading was all the way back, before this, so pretty much January 2023 was the last time we actually had these levels elevated. So we're getting back into gear. Or will this be a blimp? Will this be just a outlier figure, and then we come back down and fears are back on? But the stock market liked this data and had a good day today. What else did very well today was Walmart. Up 6.5% after its earnings report came out. Very positive. As you can see here, July, so 3.76% beat quarterly from July to April to July period. Okay, surprise, it's very, very surprising. And so the EPS, so it was expected to be 0.65 per share. And it came in at 0.67. So it did beat there. Also, expectations, revenue. So we expected 167.38 and it came in at 167.77. So only beat by 0.23%. So not very, wow. But the other one was a big beat. But nevertheless, you look at these numbers and you go, are these revised down? And most likely they are. Like you say, to make themselves look good, but I reckon they were revised down, to be honest, as I don't think consumers holding up quite well, as I showed in yesterday's video. And, in previous videos where this personal savings rate for the US is 3.5%, but no one's got any savings left. So they're really struggling to make ends meet in this current inflationary environment. You see inflation rate going down year over year, but the everyday person goes, nah. It's not the reality we're facing at the moment. We're really facing high costs living, and because the housing is very, very straining on people, goods and services, and autos, insurances. You know what I mean? Insurances are really, really bad, and just other stuff making the index as well. So yeah, everyone's feeling it, and Walmart did beat, but I do think they were revised down. Okay, I was watching a video. Rebel Capitalists, and they were explaining about this in depth, and he did find a document that did mention that the last quarter's figures were revised down. So this, most likely this quarter's one was revised as well. Okay, so take it if you will, but go and watch his video, recent one. It talks about it, all right? And CNBC article. So Walmart says prices are coming down except for one key area. Walmart said that inflation was flat in its last quarter, latest quarter. The revenue growth came from selling more items and drawing more visits to its stores and website rather than higher prices. So they're saying it wasn't the higher increases in prices because obviously their costs go up. They pass it on to the consumer, but they're not saying it's not increasing prices. They're saying it's because of selling more items. We'll have to wait and see there. Yet prices have remained high in some parts of the store, such as dry groceries and processed foods. Prices at consumer brands, including Walmart, have faced more scrutiny from both consumers and politicians. Prices of many groceries and other items have fallen at Walmart, according to CEO Doug McKillen. And he said, yet the leaders, nation's largest retailer, said Thursday that inflation has been more stubborn in one particular part of the store. So not all, but one part, which is dry groceries and processed foods. And you scroll down and read more about it. So you got McDonald's, for example, launched a $5 value meal in late June and decided to extend the offer for most markets. Target in late May said that it cut prices to about 5,000 frequently shopped items throughout the summer, such as peanut butter, milk, and meat. Okay. So Target said it would cut, and McDonald's is starting to do the value meals. So they're starting to bring back the cheap deals because people that can't afford their regular burgers and chips and whatever else. So it makes sense that they have to start pulling back their prices. And not just Walmart rallied, you had Target, Best Buy, Macy's as well. So they went along with Walmart's big rise up in the recent session. And then you've just got Walmart is touting discounts. The retailer said that 7,200 rollbacks its term for short-term deals across categories and quarter that ended July 31st. That number included 35% year-over-year increase in number of rollbacks for food. Walmart's profits are growing faster than its sales, McLennan said, that because of growth outside the retail in higher margin businesses like advertising, not higher price on goods. We're not raising prices, we're lowering prices, McLennan said. We don't want product margins going up when we talk about margins improvement in our company's business mix. Okay. So that is that there. And the article is going over that they're seeing positive out, because people really look to Walmart because they're a cheap retail chain. Somewhere like a Home Depot is a bit more expensive, and you can get that similar stuff at Walmart. Why wouldn't you just go to Walmart and get it? If you can cut costs on those items, to do, if it's anything to do with the home improvement sector, or if you're everyday items, just anything, they sell a lot of different variety. A lot of more people are looking to Walmart because it's cheaper, it's way more efficient, and like I said, and it just makes sense that more people are flocking to Walmart and getting out of the more expensive retail chains, and they're prospering over it, which is quite interesting, and they're looking at lowering prices to the consumer, like McDonald's has done and Target has done, and many others are starting to do because the consumer is starting to weaken, so they have to stimulate that side of things, and so not looking too bad ahead for Walmart, but we'll wait and see for that one. Anyway, we have Fed rate cut probabilities, and probabilities have changed, for September. Instead of that being a 50-50 chance the other day, now it's 72.5 versus 27.5. So this is a 50 basis point cut and a 25 basis point cut. You see that it's more likely to have a 25 basis point, so a shallower cut than a big aggressive cut, according to these probabilities for August. For September. We're in August now, so September, as you see there. And then next month, so another 25 basis point cut after that, is more likely. And then a bigger cut, and then another gradual cut, after that. Again in December. So 25 basis point cuts are warranted. Whether we get a bigger cut, we have to wait and see if the jobs numbers come out, unemployment data before the Fed meeting happens in September to see if the pain gets them to do a bigger cut. But at the moment, little cuts are coming, So that is that. And lastly, I just want to go over the stock market. So as you can see, the S&P 500 had a big day there. Nice big candle, 1.6%, and the Nasdaq up 2.5%. Quite big, and we're at this level. Okay, level I drew in yesterday's session. I said that this could be the last line of defense for the sellers to step in, and today, well, the session is gone. It happened. It has occurred in one big candle, which is quite shocking. So from the top to the bottom, 786 nearly has been tagged. So right at this crucial level now, where the buyers have to really break through and push higher, or the sellers will step in, and it is over for this rally for the stock market. Okay, so that happened. The Nasdaq rode this, pretty much the same sell-off zone as I mentioned, which is the 618 level, I believe. Bring up the tool to confirm, and the 618 has been tagged on Nasdaq. So the Nasdaq and S&P is sitting at crucial levels now, in my opinion, where we can really break down from and head to lower prices. 4,600, first level there, and if it gets really bad, 4,100 are my predictions. And for Nasdaq, it's more or less similar levels. So I'll go to, that's the futures chart. So it's a similar sort of bottoming period in end of 2023, 14,000, and above that is 15,900 for the Nasdaq. Okay, so that is that. We also have, I'll just show you some other ones. The Dow Jones transportation average. So transportation's more of a discretionary sort of risk off, like not like these financials or like tech stocks and semiconductors and all. This is more sort of transportation, so very, very bedrock economy sectors essentially. And you can see we're in this triangle, from October 2021 or November 2021 to September 2022, and we're sort of zigzagging in between, and we're really squeezing here. And we did have a bit of a pump, but it did wick up and then go down again. So 1.2% gain, but nevertheless, it was a pretty interesting sort of day for that one. And I'll just have targets down here, 13.5 and 12,000 respectively for that one. If you look at the percentage drop, 13.5% and 23% drop. Okay, for that one. As you can see there, it looks like it's in a very, very indecisive moment. It has to break up or down to really decide the direction. And if it breaks down, it's bearish for the stock market. Okay. If it breaks up, it's risk on for now, all right? So it's very, very interesting. This one will be really the decider, the strength of the underlying economy. And these tech stocks really have to weigh in whether the AI hype is still there and the company's earnings are still strong and the consumer's holding up, or it's the opposite. It's not holding up at all. So you only have the Russell as well. Okay, the smaller cap stocks. And we're in this sort of channel here, up and down, ranging. We broke above it. Had a nice move, from June, July, and then boom. And now we're back down. You reach that level, and we're sort of pumped from that level, the support level. And interesting to see if we do come up to these highs again, or we come up to this high, or we come down back to these lows before ultimately breaking lower. Okay. And this percentage drop from where we are right now would be a 23% drop. All right, back to these lows, as you can see down here. Pretty prevalent, pretty obvious. Okay. And that could be short-term lows, I think, or we can go lower. But I think that's just going to be. I think this is going to be a pretty strong level for the buyers to step in if the recession hits, and they haven't been doing really as well as the stock market has this year. If I'll just show you real quickly from January, pretty much is from here. Oh, sorry, I'll just bring it up properly. So from Jan 2nd, roughly to now, we're up 6.6%. So it really hasn't done much this year. The small cap stocks, look at the Nasdaq from the start of the year. And right around there, if you want to be fair, we're up a bit more. We're up 16%. So a lot more. than the small cap risky stocks. And the S&P, if you want it's just measuring thing about there, right, to where we are, and it's done 16% as well. So equally as good. And the small caps are lagging behind. So that is that. And yeah. All right, I hope you enjoyed this video, just going over retail sales numbers coming in better than expected. We also talked about Walmart's and their positive beat in earnings. As you see, the CEO is pretty joyful and pretty thrilled with it. Anyway, they, see that prices are going to cut costs for the consumers. They're really struggling. We've also looked at, McDonald's in there as well, and Target. They're starting to come up with their deals. And, the rest of them is going to follow suit, because Walmart's one of the biggest chains, and they've got to stay competitive. And these more expensive stores have got to really consider their options for their consumers is really, really tight for change. As I mentioned, the savings rate is like 3.5%, I think, going back to 2022 and 2008, respectively. The last time these have been this low for the consumer. Anyway, that is that. And then we talked about the rate cut probabilities changing from 50-50, from 50% rate, a 50 basis point cut and 25 basis point cut, to now favouring a 25 basis point cut in September. So not as aggressive as predicting, but that could all change with the job numbers coming out worse than expected, unemployment rate and non-farm payrolls right before the Fed meeting in September. Okay. And then, just went over the charts and seeing that the NASDAQ and S&P are right back to the levels right up there at the fib retracement levels. So the 786 for the S&P and the 618 for the NASDAQ. So they've reached up there already, which I didn't expect to happen so quickly, but it has happened. And crucial for the sellers to step in and defend this level, or will price go higher, back to the all-time highs, make a double top, or even break that and go higher. We don't know, okay? It's just a matter of the animal spirits and the high-tech stocks, the AI craze, and, just carrying along the rest of the market with it, essentially. And just companies just bringing in better earnings, beating expectations, and this recession fears sort of starting to dwindle away. If that happens, then we're going to keep going higher. But I see recession fears on the horizon, getting worse. And as indicators like the SARM rules being triggered, inflation heading down, which is good for the Fed, but the jobs numbers not quite coming in very good. And it's something that it's really going to be a definite thing to call a recession. I think the jobs numbers getting worse and employment taking off, and the Fed having to step in and really cut. But if they come in better than expected and jobs start to soften and come back down, then I guess we can go higher in the markets. But we have to wait and see for that one. And that is pretty much the video. We just went over the Dow Jones Transportation Index we haven't looked at for a while, and the Russell, seeing how that's tracking, and target predictions for those ones going in the year. If they get hit, they get hit. They don't get hit, and don't stab me in the back, okay? Don't. It's just predictions, a bit of fun. It's nothing financial advice, okay? And that is that. So if you like the video, please smash the like, comment your thoughts below, subscribe to stay updated. Be sure to check out my links below, and I'll catch you next one. Cheers.